Hello everyone, I'm super excited to kick off our journey into the world of finance and investing. Today, we are diving into one of the most crucial concepts, company valuation. Whether you are an aspiring investor, a business owner, or just curious, understanding how to value a company is absolutely essential. So, what exactly is company valuation? Simply, it's the process of figuring out the economic worth of a business. Think of it like this: when you buy a house, you don't just pay whatever the seller asks, right? You look at its feature, its location, comparable sale, and then decide what you think it's worth. Company valuation is exactly same, but for business, big or small, we are trying to determine its intrinsic value, its true worth based on its assets, liabilities, and most importantly, its potential to generate money in the future. Why is this so important? Well, valuation is the bedrock for some of the biggest decisions in the financial world. First is merger and acquisition. If one company wants to buy another company, they need to know what a fair price is. Second is investment decision. As an investor, you want to buy a stock when its market price is below its intrinsic value and potentially sell when it's above it. Valuation help you find those opportunity. Third is capital raising. If a startup need funding, valuation helps them determine how much equity to give away for a certain investment, and many more, from financial reporting to tax purpose. Most valuation method boil down to one fundamental principle: a company value today is the present value of its expected future cash flows. Sound a bit technical? Don't worry, we will break it down in the future videos. But essentially, money today is worth more than the same amount of money tomorrow. So we discount those future earnings back to what they are worth right now. Keep this core idea in mind as we look at the main approaches. There are three main valuation approaches. First is income approach. This is all about a company's ability to generate cash in the future. If a business is cash generating machine, it's generally more valuable. The most famous method here is discount cash flow or DCF. We forecast all the cash a company will generate over the years, and then we discount that back to its today's value. It's like predicting how much fruit a tree will bear over its lifetime and then calculating what that future harvest is worth to you today. Next, the market approach. This is often the most intuitive. It asks what are similar companies selling for, or what are similar publicly traded companies valued at. We look at comparable companies and precedent transactions, basically what other businesses like ours have recently been bought or sold for. We use metrics like price to earning ratio or enterprise value to EBITDA ratio to compare them. It's like looking at the price of your neighbor's house when you are trying to sell yours. Finally, we have the asset approach. This method primarily look at the value of a company's assets, its property, inventory, and even intellectual property, and then subtract its liabilities like debt. This approach is particularly useful for assets heavy businesses like real estate companies or for business that might be liquidating. It's like calculating the value of a car by adding up the value of its part, then subtracting all the outstanding loan on it. So, to recap, we have the income approach focusing on future cash, the market approach looking at comparable, and the asset approach valuing the balance sheet. In practice, finance professionals often use a blend of these approaches to arrive at a well rounded valuation figure. No single method is perfect and each has its strengths and weaknesses. This was just a high level overview, but you now have a foundation understanding of what company valuation is and how it generally works. If you like this video, please hit that like button and subscribe to our channel. In our next video, we will deep dive into each of these methods, starting with the DCF analysis. Thanks for watching. See you in next video.